Hello, everyone, and welcome back to another episode of the Weekly Tanker Market Podcast, where we navigate the complex waters of the global shipping industry. I am Research Analyst Shruti, your host today, and I'm thrilled to be joined by shipping and commodity expert Mr. Sandesh Ghandat. Sandesh, thank you for joining us today.
Well, Shruti, thanks for having me here. It's always a pleasure to discuss fascinating dynamics of the tanker market.
So, Sandesh, the past week has seen some intriguing developments across various tanker segments. So, let's dive right in and decode what's happening in each sector, shall we? Starting with the VLCC market, we have seen some interesting movement in the Middle East Gulf region. So, what's your take on the softening that we have recently observed, and what factors do you think are driving this trend?
Well, that's an excellent place to start, Shruti. The VLCC market out of Middle East Gulf, it has indeed experienced a gradual softening throughout the past week. And it's a fascinating case study in the market psychology. What we are witnessing is a fundamentally slowdown in the cargo inquiries, particularly for early April loadings. So when I look at the data, what strikes me is the cautious approach charters are taking, and it's almost collective wait and see strategy. The hesitation, it kind of creates a feedback loop that further suppresses rate. One particularly interesting development is how the gap between oil relate VLCC rates and independent VLCC owners has narrowed considerably. You know what? Historically, this convergence often signals a market approaching an inflection point. So if I may share a personal observation, this period of hesitation, they often precede a sharp correction. Rarely does the market remain in the uncertain state for long. So what's providing some counterbalance to this downward pressure is global ship availability, and in this case those are VLCC tankers. So the supply side is offering some resistance and preventing rates from free falling. And we can't discuss the current VLCC market without mentioning the midweek discussions about the potentially reiterating Russia's shadow tanker fleet. So if this materialize, we could see a fundamental shift in the global tonnage supply that would ripple through the rate structures worldwide. The saving grace has been Atlantic basin really, because there we are seeing a firm loading demand, and that's kind of helping stabilize the sentiments. So without the Atlantic activity, I believe we would be looking at a much sharper decline in the rates.
Alright, Sandesh, that brings me to my next question to you. So the big question about the VLCC market in West Africa. How does that region compare to what we are seeing in the Middle East Gulf?
Well, the WAF, that is West African market, it presents a more pronounced version of what we are seeing in the MEG. And Shruti, the softening trend there, it is driven by an even more critical factor. And that factor is limited fresh demand against an expanding tonnage list. The West African market is particularly interesting because it sits at the crossroads of signals from both MEG and US Gulf. So earlier last week, we saw a significant uncertainty as the MEG showed up signs of tightening with vessel privately fixed, and it does create a mixed signals for owners operating in the West Africa. So what's particularly telling is the off-market fixings we have observed. In the fixing, there should be a transparency, but this limits the transparency, and it kind of creates information asymmetry in the market, and something I have always found to be leading indicator of shifting fundamental. So when you couple this weak demand with the softening conditions in Brazil, you get a perfect storm for downward pressure on rates. So the US Gulf did show some strength, but it wasn't enough to offset the weaker fundamentals in the West Africa. Now, if I have to mention here, looking at the historical patterns, when we see this combination of ample tonnage availability and then the low inquiry levels persisting for more than a week, it typically signals a continued downward trend. And until we hit a support level where owners begin to resist further discounting.
Well, Sandesh, that's quite interesting because the US Gulf seems to be telling a different story altogether. We have seen some significant rate movements there. So what's happening in that region that sets it apart?
Well, the US Gulf, it has indeed been the bright spot for the VLCC market. And Shruti, believe me, it presents a fascinating contrast to what we are seeing elsewhere. So the US Gulf started with a remarkable momentum with freight rates for the USG China route, that is the benchmark route in this particular segment. It surged to around $8.2 million, and that is on a lump sum basis. And it was a figure that exceeded even the most optimistic market conditions. These bullish sentiments, they kind of continued to build, and the rates that push here, they reach even higher to around 8.5 million, again on a lump sum basis. But what's particularly noteworthy is the multiple VLCCs placed on subjects indicates genuine demand rather than a speculative activity. So at one point midweek, we saw ex US Gulf and UK continent fixtures. They closed around $3.85 million lump sum basis. And these particular numbers we haven't seen consistently since before the pandemic disruption. So, as someone who watched this market for years, what's most interesting is the owner behavior towards the end of the week. So, despite slowing activity and then the lack of fresh testing, the owners they kind of maintained a remarkably firm stance, and they are holding out for $4 million for ex USG UKC route. So it is a clear indication that they believe in the underlying strength of this market. Now the contrast between US Gulf and other regions, it highlights the increasingly fragmented nature of global shipping markets, and then the regional factors now seem to be overriding these global trends more than ever, and we have seen the same in the previous cycles.
Rightly said, Sandesh, the contrast between the US Gulf and other regions is truly fragmented in nature. So, now moving ahead, let's shift gears and talk about the Suezmax segment. How would you characterize what's happening in the Middle East Gulf for Suezmaxes?
Well, the Suezmax market in the Middle East Gulf tells a fascinating story of geopolitical influences and how these geopolitical influences reshaping the trade flows. So last week it began with a notable strain, specifically India-bound voyages, direct consequences of buyers seeking alternative to Russian barrels. So that's why I have mentioned the geopolitical influence. So this is a textbook example of how sanctions and political realignments they can create a market opportunities. Cargo inquiries were increased specifically for this particular route, while non-Indian routes remain mostly untested, creating a two-tier market within the same segment. Now, as the week progressed, we observed demand for India focused cargoes in early April beginning to ease. This isn't a surprising because these surge patterns typically last 7 to 10 days before normalizing as supply chain adjusts. So by midweek, activity had quieted considerably with almost no vessels on subs and rates holding within a narrow range, essentially a market catching its breath. So the end of the week, it brought signs of stabilization with an interesting divergence, and at the same time, eastbound routes they kind of remained firm while westbound rates they kind of saw a slight dip. So this bifurcation suggests a structural shift rather than a temporary anomaly. So just to look at the numbers, we are seeing the rates hold in a band that's about 15% higher than a 5-year average of for this particular period, and indicating fundamental support despite week to week fluctuations.
Alright, now let's move on to the Aframax segment. This size class often behaves differently from VLCCs and Suezmaxes. So, what's happening in the Middle East Gulf Aframax segment?
Well, the Aframax market in the Middle East Gulf has been showing remarkable resilience. And Shruti, it's a fascinating case study is how vessel availability, particularly for the modern tonnage, it can drive the market dynamics even in the absence of frenzied activity. So throughout the last week, we saw rates gradually strengthening despite limited reported fixtures. And you know what? This paradox is explained by vessel availability specifically for newer vessels that meet stringent charterer requirement. So owners held their ground firmly, supported by a steady flow of cargoes. So when I find particularly interesting is the narrowing earning gap between MEG and Southeast Asia market. So if I have to see analytically, historically, when this market approach equilibrium, it signals a potential inflection point, and adding to this particular dynamic is owners' preference for ballasting west, which further constrains supply for eastbound cargoes. So this strategic positioning of vessels isn't enough attention in the market analysis, but it's significantly contributing to the firm sentiments that we are currently observing. So the numbers, they always tell the story. Utilization rates for modern Aframaxes in the MEG, they reached nearly 92% last week, well above the 85% threshold that typically signals a tight market. So while market activity appeared to subdued in the terms of reported fixture, the underlying fundamentals remains robust, and that's why there is a lesson here about looking beyond headline fixture reports to understand the true market conditions.
Well, that leads us nicely to our next segment on product tankers. We are seeing some interesting developments there. So, can you break down the LR and MR market for our listeners?
Well, thanks Shruti for that question. Let me start with the LR market first. The east of Suez LR tanker market has been particularly fascinating to watch. And Shruti, we witnessed a late week rebound that caught many market participants by surprise. A surge in inquiries that narrowed the freight spread between LR2s and LR1s, and it was just 5 world scale points on the AG Far East route, a spread that typically much wider. So that tells us LR1s, they are preferred over LR2s. So it's a classic example of how relative value consideration drive that chartering decision. Now, meanwhile, LR1s, they also gained a momentum by essentially drafting behind firmer LR2 rates and attracting long haul demand. However, there is an important caveat here. The ample supply of LR1 tonnage, it could exert downward pressure on upcoming fixtures. And what makes the current situation particularly very interesting is that the approaching of Eid al-Fitr holidays. So holiday season is going to be starting from the next week. So this calendar event is creating urgency among the charterers to secure the April cargoes earlier than they supposed to be. So this reinforcing the belief that the freight rates, they have bottomed out and are poised to climb in the coming weeks. Now, looking at the westward, the LR2 activity in the UKC WAF route saw a significant surge, and it was driven by an unexpected development. It was because of a drop in the gasoline deliveries from Nigeria's Dangote refinery, and that's it. That's the single reason alone. So this draws the rates up towards scale 120, a level we haven't seen consistently in this trade route for the quite some time. Now that's about the LR segment. Let me present some of the MR tanker segment stats here. So firstly, the MR tanker market presents a study in the regional contrast, Shruti. So in the east of Suez, the freight rates in the North Asia, they have held steady at the end of the last week, and it was supported by balanced tonnage list. Rates in the Arabian Gulf, they have inched higher due to tight MR tonnage availability. So what I find particularly noteworthy is the impact of private and off-market chartering. So it has effectively restricted supply and kept tonnage list tight. The owners, they still required an additional inquiries to leverage this condition in rate negotiation. So it's kind of like having a good hand in poker, but needing more chips on the table to maximize the returns. So by contrast, MR rates in the Singapore, they have come under the pressure because of always the demand factor, the sluggish demand weighs on the market. So this diversion between Singapore and then the other Asian hubs highlights the increasingly localized nature of shipping market. Now when we look at the west of Suez market, the story becomes even more interesting. So MR rates, they kind of saw upward momentum. It was driven by a firm US Gulf market, while UKC WAF, it kind of actively remained volatile before setting into balance sentiment. So the tightening tonnage leads there, it suggests a potential for continuous trend. So with that, I would like to mention this: the charterers, they are worried about this China build situation that occurred from the Trump's decision. And from the my perspective, there is another dimension to it. So the product tanker owners with the China built vessels, they are proactively inserting contingency clauses into their charter party agreements. So this is in anticipation of potential US imposed fees on such ships. Those are calling at American ports. So it's a fascinating development in how geopolitical tensions directly impacting commercial shipping practices. Now the charterers, they are strongly resisting these clauses, as they kind of stipulate that any charges, regardless of category, terminology, or connection to China, including flag, registry, ownership, or even the operational ties, it would be a charter's responsibility, is what owners are saying. So there is a tug of war over contractual terms, and it is creating a new layer in the complexity in the MR tanker market.
That's quite interesting, Sandesh. And you mentioned potential sales of Chinese built tankers. Do you see this leading to significant fleet restructuring?
Well, absolutely, Shruti. We could be on the cusp of significant restructuring in the product tanker fleet and its ownership's landscape. Ship owners, they are taking an increasingly cautious stance because they vary of escalating regulatory risk. So I have studied the industry executives conversation on the public platforms, and many of them are indicating that the potential wave of product tanker sales, it could emerge in the coming months as owners, they look to offload their Chinese built assets. Ongoing certainty surrounding around Russian sanctions as of 25th March, it kind of adds another layer of complexity, and this uncertainty could lead to the emergence of new entity in the jurisdictions like UAE and Turkey, poised to capitalize on the discounted product tankers ahead of looming deadlines. The influx of new product tankers set for delivery in the near term may even exacerbate the supply demand imbalances, and it potentially pressuring freight rates. So we are looking at approximately 45 MR tankers scheduled for delivery in the second quarter alone. It is a significant addition to the global fleet. On the broader scale, every situation in the shipping industry kind of a present opportunity also. India's ambitious $3.5 billion initiative announced in the Q3 2024 to expand its national fleet to 1,000 vessels over the next decade. It kind of presents an opportunity for new Indian ship owner to bolster their product tanker capacity. And by registering these vessels under the Indian flag, they could even unlock the tax incentives under the GIFT City initiative and making domestic ownership more attractive, in my opinion. But if there is opportunity, then there will be a challenges also, because the first and important challenge is that there is a significant uncertainty and it will persist in the coming days, because the government led initiatives, they often face delays due to complex decision making process and making execution timelines unpredictable. So based on historical precedents, I would expect perhaps 10 to 12% of the announced capacity to eventually materialize specifically into the product tanker sector, but it kind of a spread over a longer time frame than initially projected.
Thank you for that detailed explanation, Sandesh. And before we wrap up, I'd like to touch on the LPG tanker market, which is crucial for global energy flows. What are the key developments there?
Well, the LPG tanker segment has particularly intriguing in the past week because in the East we witness what I can only describe as a peculiar market behavior. An Indian charter unsuccessfully bid up to 63 per metric ton basis Ras Tanura Chiba for 22nd 24th April Das Island cargo. Yet later in the week, another cargo was fixed on the Friday, and it was at an unrepresentative $48 per metric ton for 22nd April loading. So what's strange is the noticeable lack of cargoes before the second decade of April. So this usual gap in the loading program, it has created uncertainty among both owners and charters. Now having said that, East of Suez market overall saw three deals. It kind of conclude across early, middle, and late April weekends. So with the rates, they are slipping to the mid 50s per dollar per metric ton. Basis Ras Tanura and Chiba amid muted activity from the Arabian Gulf. So owners are now pinning their hopes on increased April Arabian Gulf freight inquiries next week to support rates and the sentiment.
Well, Sandesh, we have covered an incredible amount of ground today across all the major tanker segments. And before we wrap up, let me thank you for these incredible insights that you've given. Your analysis has not only covered what's happening, but why it's happening, which is exactly what our listeners need to navigate these complex markets.
It's been a pleasure, Shruti. Looking forward to our next conversation, and I'm really glad to be part of this. Thanks for inviting me. Thank you once again.
And to all our listeners, thank you for joining us today for another episode of the Weekly Tanker Market Podcast. If you found value in today's discussion, please subscribe to our podcast and share it with your colleagues. Until next time, navigate safely and stay tuned.